is basically a third world country at the moment, getting a building off the ground. It's very difficult. There's not enough of them being built. And of course, the bullwhip effect of that down the track is going to create higher prices. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code cracking stuff. Yes, we're decoding market downturns. Do you love a decode? If you're a decoder, then hey, welcome. You've come to the right place. Of course, if you're going to crack some codes, you got to decode things. And we're going to tackle market downturns because hey, there's always a bit of volatility out there. There's always a little bit of opportunity. And of course, sometimes it's better to be a bit of a contrarian investor when it comes to real estate. So can we decode market downturns? I think we can. That's what today's show's about. Welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are lessons on real estate, so feel free to go back in time. You can find some gold nuggets, that is for sure. I just realized Rafi has stolen my Ugg boot and has put it underneath my desk. So I have found a slipper, an Ugg slipper under my desk. There is not two, but hey, that's good news. I've been looking for that. It is now found. It's decoded. We have decoded the missing slipper. But let's decode something of more value than my missing shoe. Yes, we're going to dig into how to understand some economic principles today. So take some notes. I think it's going to be a good show. But of course, real estate is just really part of a bigger puzzle. And of course, that puzzle links to a couple of concepts. Firstly, the economy. Secondly, money. And thirdly, confidence. And actually, one way to navigate real estate and understand where markets can be and where people's heads are at is a concept known as E equals MC squared. Now, of course, whilst it sounds very Einstein-y, it really is a principle that the economy is driven off money and confidence, and money and confidence together creates a square root effect or a multiplier effect, which leads to economic growth. And of course, confidence and money, if you put it together, you're going to get a financial outcome. But of course, when confidence is low and money is tight, what can happen is it can create a high level of opportunity. So there's strength in an economy when money is circulating, when money is growing, when economic activity creates growth. Of course, when confidence is high, off the back of that, you will get economic activity. When confidence is low, you'll obviously get a dampening of the mood and, of course, economic performance. So I like to break down the economy into two sections. And probably the section which everyone concentrates on is the money section. Remember, economy equals MC squared. So the money section is a good section. I like talking about the money section too. I'm like everyone else, the money section is probably the section where a lot of the voice from everyone, from the treasurer, from the Reserve Bank of Australia, will concentrate on the money section. The money section is made up of quadrants, right? You've got your GDP, which is the country making money. What is Australia's GDP outlook? Will we actually create more as a populace to produce economic output. And obviously that's a measurement of money. Inflation, which is just the basket of goods. What do things cost? What does your $100 Australian get you? Obviously, it's getting you less at the moment than it did 5 years ago, than it did 3 years ago, than it did 2 months ago. And of course, obviously, the cost of a basket of goods is a very, very important concept for property investors, because ultimately real estate is a big hedge for the basket of goods. It grows in value. It outperforms inflation, which is one of the reasons people hedge it, because they can end up in a better place down the track off the back of property. It just outflanks inflation. But inflation is a measurement of money. Remember, economy equals MC squared, money confidence squared. Obviously, when you're measuring overall the money side of the equation, you would look at, for example, the labor market or the jobless rates. Of course, we are in a very low unemployment sector of the world, but employment is creeping up a bit. And of course, if there's strong employment, then there's usually money being made by people and even wage growth. So again, these are measurements of the concept of money, and an important part of the equation we're looking for when it comes to decoding really the market downturns. And of course, the measurement of money is what is happening internationally. Are other countries making money? If other countries are booming, sometimes there's need for resources and other activities is so strong that it creates money here. So again, if we analyze these kind of variables, we can work out what is kind of going on. And of course, other than international activity, you can also measure house prices. Are house prices going up? House prices are really a measurement of confidence in a localized economy, whether that's New South Wales, Queensland, South Australia, Victoria. Are house prices going up? Is one, a measure of confidence, but two, is also a challenge for money at times, because if house prices are too high, there is effectively less money being circulated in the economy going back into businesses being spent because everyone's putting their money into their mortgage. So that can be counterbalanced by the wealth effect, where people have home equity, and home equity can also create more money in the system, which creates more spending, which creates more growth. So it is a measurement of money. Housing is a measurement of money. And of course, building approvals is also a measurement of money, which right now, by the way, building approvals are just, I was explaining building approvals to a gentleman the other day, and I just said, look, Australia's building approvals are so bad. Just think of a third world country and how chaotic they are. That is really Australia's building approval system at the moment. It is just not functioning. It's basically a third world country at the moment, getting a building off the ground. It's very difficult. There's not enough of them being built. And of course, the bullwhip effect of that down the track is going to create higher prices. But building approvals is an important measurement of money, because if things are getting built, growth comes from building. Now, in Australia, there are also mega projects underway, big transport projects, which are also building approvals. It doesn't just pertain to residential activity. And there is a lot of activity happening. And I might come back and do a episode just on what is going on in the building approval space in certain locations, because I think it's worth having a good old-fashioned chat about. But money is also connected to another principle, which is business insolvencies. And of course, businesses go bankrupt all the time because the sheer nature of business is volatile in its DNA. So what needs to be measured are business insolvencies. Are we losing effectively more businesses than we are starting businesses? Are we actually growing money by the circulation of more businesses being created? And here in Australia, one of probably our challenges is just getting more innovation and more businesses going as a whole, as a country. So businesses, are we losing businesses? Are we gaining businesses? Are we breaking even on new businesses? Obviously, businesses create jobs. And it's fair to say the jobs market is still very, very tight. We'll have a look at some of that data, but it is tight. And of course, business investment is another measurement of money. Obviously, when businesses make a profit, they can do two things. They can pay a dividend to shareholders that own a proportion of the business, or they can retain the earnings and reinvest in the business to make it bigger, faster, more productive. They can retool it, reskill it. They can create business investment. And of course, business investment ultimately creates money. So money is a big part of this puzzle, and probably the one when the Reserve Bank meet, every couple of weeks, then really they're analyzing a lot of this kind of concept of where is the money flowing? Is it flowing? Is it bottlenecked? Is it going to get challenged in places? And are people spending? Are they spending too much? How does money flow? And ultimately, their job is to then set the price of money. Obviously, they will also consider commodities. Are commodities selling at a fair price? Are commodities priced in line with where Australia needs the commodities marketplace? Are world commodities being flooded to the market, or can you get a premium for commodities? Commodities, obviously, what a country sells. And here in Australia, we're kind of blessed to be the world's quarry. So we have a lot of commodities. So we can create a lot of revenue off the back of rocks in the middle of the desert, which is really, really helpful for Australia because other than commodities and selling that, one could argue there's a lack of industry in Australia. But obviously, you've got to consider what the stock market is also doing, because if the stock market is providing dividends, it's creating money for people. And so the economy is made up of money, and the Reserve Bank then sets the cash rate off effectively what is happening with money. And of course, right now that cash rate is also really being set off the back of a basket of goods. And of course, to measure a basket of goods, we have this thing called inflation. We analyze the annual inflation rate. Effectively, what does $100 get you today when it comes to a goods or services? And I think we've all seen the cup of coffee go from $4.25 to $6.75. Obviously, your buying power is being eroded, and obviously the Reserve Bank understands that. And of course, unless wages keep up, which they're not, they're having to adjust the cash rate accordingly to induce basically slowing down inflation. And of course, what this will end up doing is making Australia's money market pass through the eye of a storm. And really, when we look at where we're probably at the moment, we're probably in the middle of the storm right now. We're passing through the eye of the storm. Australia's economy is slowing, and it's being slowed really by lots of factors, but one of the factors is rising the cash rate to slow the economy down to ultimately bring back some higher levels of inflation. By slowing the economy, we're going to increase the unemployment rate. And of course, that means that the unemployment rate figures will rise. You'll probably hear that on the television when you're listening to the news. But if we look at the long-term trend for unemployment, it's going to sit circa 4%, which is very, very low by historical standards. I mean, you could go back to 2016 and the unemployment rate was circa 6%. Obviously, a much higher figure than where we find ourselves today. And sometimes in life, we just have short memories. We don't remember what was happening, 5, 6, 7 years ago. And of course, from an unemployment level, the rate of unemployment is now still historically very, very, very low. So we know money is feeling a little bit expensive to buy at the moment because the Reserve Bank have the money set at the current rate. We do know, though, that the market is suggesting the cash rate will eventually start to drop. Obviously, the country is going to earn less money. GDP is going to drop. Unemployment is then going to rise, and the variable then is interest rates will peak and begin to fall away. And so we can see that by really our forecast through Oxford Economics is you'll start to see a cash rate reduction probably first quarter 2025. And again, all of those three principles of money are very much linked together. So then we get to the other side of the E equals MC squared equation. The economy equals money, confidence multiplied. Confidence is an interesting one when it comes to real estate. I think sometimes the money market is such a high-level variable for people at times other than what a mortgage rate is, that the confidence effect is felt really more deeply in the street. A lack of confidence can ultimately, for a property investor, lead to much better prices in the marketplace. And of course, you have to look at that depending on where you're at. If you're a holder of real estate and a market loses confidence, effectively prices will sit stagnant or even drop in value. And that can do your head in as a holder of real estate. But as a buyer of real estate, of course, a lack of confidence can lead to much better pricing. And of course, as fear and uncertainty prevail, it ultimately causes sellers to lower their price. The trick to being a property investor is to use a lack of confidence to buy real estate, but equally, if you have real estate which is affected by a lack of confidence, not to do anything but just to see out the lack of confidence. After contraction comes expansion, and after expansion comes contraction. It's generally the way of the world when it comes to economics. So what are the dents in confidence we have to consider? And I think there's some 6 Ds that I look for when it comes for decoding really a market's confidence, where it's at when it comes to is the market actually a really good buy because there is a downturn on at the present time? And is confidence so low that you're really getting a mispriced asset in the market? Remember, confidence is just people, when the money side of it is all sorts of stuff: jobs, inflation, global trade. The confidence section is just how we feel ultimately. So what rattles the cage of confidence is ultimately the question here. The first one of the 6 Ds is debt. Obviously, debt refers to the amount of money not only borrowed by people, but governments, businesses, and ultimately debt is something that needs to be managed on all levels of industry, whether it's a company's debt, whether it's a household debt, or whether it's a government level of debt. And when there's a high level of debt, you can almost be guaranteed that there is a lack of confidence in that particular marketplace. And of course, if an area's debt levels are just too high, you're going to see a vulnerability of confidence. Even at a household level, if a household level has high debt, you're going to see a level of confidence being challenged. Now, we know that just even at a household level right now, we're passing through the center of the money storm, and repaying basically a new mortgage is tough for people. But ultimately, most people are not on new mortgages. They're on old mortgages, i.e. they've already paid off 15 years of their home loan. They're not starting a new home loan. But we need to understand that debt can ultimately create a confidence issue in a marketplace. Not to be misconstrued with distress in the marketplace. Distress. Obviously, at a household level, old mate Bob could be struggling to pay the mortgage and is going to fall into mortgage distress. But high levels of debt in a marketplace can create ultimately a lack of confidence, and a lot of that debt can be government-led debt. The next D that usually signals a lack of confidence in a marketplace, which for a property investor, they need to weigh up what they're going to do about that lack of confidence, is deleverage. Deleveraging is ultimately the process of reducing debt levels in an economy. And it means there's just less spending going around because more money needs to go to paying the debt. And of course, for governments, in some respects, certainly at an Australian government level, they can kind of print money to get around deleveraging. But it can lead deleveraging to less money being circulated in the economy, and reduced economic activity, and ultimately see a level of confidence being stripped out of a marketplace. And so it's just something to analyze when we analyze this concept: economy equals money and confidence multiplied. E equals MC squared. The other thing to measure is the opposite of inflation, which is deflation. Now, technically, inflation means things are growing. You want a level of inflation in your economy. And of course, deflation, i.e. the idea of the reversal of inflation, which ultimately is a period of declining prices for goods and services, usually has also a bit of a short-term adverse effect on a marketplace. And again, you can get deflation in all sorts of variables within the economy. You can get deflation effectively on businesses. Certain businesses effectively are not as popular as other. You can get deflation on places. Some places today are less popular because people work from home. And so when a marketplace is going through this a level of certain deflation, it can create a lack of confidence. And I know here where I am in Sydney, public servants weren't required to go to work, so there was a lack of confidence in businesses trading out of certain CBDs here in Sydney. We've got multiple CBDs. Now all of the government workers are back to work. The level of deflation for those businesses, the drop in value of their goods and services has come to an end. So the market is more confident to grow again because the deflation has come back out of the system. Not to be confused with the concept of curbing inflation, which is important, but you don't want to completely deflate everything as well. So it's a balancing act between overinflating things and over deflating things. Deflation can be very, very harmful. And, ultimately that process can lead to a lack of market confidence. The next D, which I think is one of the Ds which has hurt, for example, the Melbourne market right now, making Melbourne one of the best buying markets in the country, is a dictator. Yes, Dictator Dan did a number on the Melbourne marketplace, locking it up for a very long period of time, the longest actual lockdown in the world. And of course, it's created a lot of trauma for people off the back of what unfolded. And of course, was Dan Andrews what happened to Dan Andrews? There are rumors. Some people say he got bashed up. Some people say there's rumors circulating. Did he really fall off the ladder? Was Dan Andrews the Manchurian candidate? ASIO found a Australian political person that was leaking information to foreign governments. It was very, very weird, the end to Dictator Dan. But of course, we could conspiracize about that forever. But the dictator concept of an authoritarian figure basically exerting control over an economy can absolutely kill confidence. And of course, an example of that is live right now, whereby Dan Andrews' government policies during COVID created a policy after COVID of property taxes. So land tax money now needs to be paid if you're a property investor in Melbourne. Now, it's not a hell of a lot of money, but it's still dense confidence. The average property investment entry levels like $980 a year. But what that can do is kill confidence. And again, confidence is a interesting concept for property investors, how they want to understand confidence, how they want to apply themselves to an unconfident marketplace is really a conversation piece we're going to have. And of course, the final confidence concept, or one of the final confident concepts, is depopulation. When people leave places, they can obviously leave a void. And of course, here in Australia, we have a lot of immigration, but in some countries, they have emigration, the opposite to immigration. Emigration is people leaving your area or your place. And of course, that can dent confidence. I know in New Zealand right now, confidence is dented because of emigration, not to be confused with immigration. I know, for example, during COVID, a lot of people left Victoria to get away from the dictator and emigrated out of Victoria and immigrated into southeast Queensland, which became the beneficiary of the emigration. Now, I don't know if you can hear that. It's raining cats and dogs. It feels like almost like I'm being pelted by ice. Is there something at play outside? I don't know. But anyway, I hope it's not being picked up on the mic because it's very, very loud. So basically, depopulation can create a confidence issue. It can create a confidence issue when you know someone from school and they're leaving, and you get this kind of the world's ending kind of effect. And of course, the final D when it comes to understanding confidence is also connected to the global world, deglobalization. And ultimately, we are going through deglobalization right now, a reduction of global interdependency. We're decoupling ourselves from, countries around the world. At a domestic level, we're pulling back. This is really a global trend, and it can obviously create a confidence challenge on marketplaces. So we've got the economy, we've got the concept of money, and then we've got the concept of confidence. Now, the beautiful thing about confidence, it can be quickly fixed. It's not a major problem. Confidence is just humans basically feeling more confident about certain things. And I think if you can be confident about debt, confident about deleverage, about basically where the economy is at, you're confident in your leadership and you're confident in your people, you're going to ultimately get back to a market confident state. Now, remember, there's a property cycle. The property cycle is an important cycle. You've got phases in the property cycle. A property market will be at the bottom. A property market will rise in value. It will recover in value. A property market can boom in value. It can peak in value. A property market can slide in value, and a property market can actually also go sideways in value, just troughing along. So that's normal. It's all very, very normal. But if we were to analyze probably where a buyer's market is right now for anyone who wants to buy real estate, The figures, the national figures of dwelling values can give us a little bit of an insight into probably what is the least confident market in the country, which conversely can create the best price point buy in the country. And if we look at the combined dwelling values of Sydney, being every dwelling as a combination, it's $1.1 million. If we look at the delta, the price difference to Melbourne, the combined value of Melbourne today is $803,000. The combined value of Brisbane, all the dwellings, townhouses, houses, apartments, is $853,000. We can see the confidence level of Southeast Queensland is very, very high. Melbourne is less expensive than Brisbane. At a dwelling value level, the confidence level is much lower in Melbourne. We can see Adelaide, which is a much obviously smaller city, is now nudging combined dwelling values of that of Melbourne, $770,000 in Adelaide. Melbourne at $803,000. So there's some signals there that if we look at the confidence that Melbourne is providing at the moment, it's not providing enough confidence. And of course, a lot of that is debt, deleveraging, deflation, a dictator, and depopulation. So then the hypothesis is, well, should we actually buy in Melbourne and pick up the value from the lack of confidence? That's the concept here when it comes to being a property investor. And of course, should we actually, if we already own real estate in Melbourne, just ride out the lack of confidence, because after night comes day, after contraction comes expansion. So in theory, we can look at some economic principles around understanding the bottom of the market. And there's really three economic principles you need to walk away from today's program understanding. The first one is contrarian investing. The second is efficient market hypothesis, EMH. And the third is Keynesian economics, the economics of animal spirit. Yes, we're conjuring the animal spirit. Now, let me just have a quick sip of water. I'm parched. But let's start with perhaps efficient market hypothesis, EMH, and market sentiment. Basically, efficient market hypothesis suggests that asset prices reflect the available information. And so for property investors, the available information in Melbourne is there's land tax. And of course, this erodes the confidence. And of course, it also makes asset values just better value. So efficient market hypothesis ultimately suggests that asset values reflect the available information. It also acknowledges that market sentiment, the confidence, can cause deviations from the asset's true value. This is an important economic principle. When confidence is low, prices might fall below their intrinsic value, their true worth, offering buying opportunities for savvy investors who recognize that confidence is actually temporary. Now, EMH, or efficient market hypothesis, to me is one thing that I just love studying, because if I analyze Melbourne right now, that is so true. That economic principle, that theory in itself is so true. that right now you can buy real estate basically below what it costs to replace. You can buy real estate with exceptional built-in value. You can buy real estate below the average rate of median growth over the 30-year period of analysis in the Melbourne marketplace. So it tells me that basically confidence is a temporary problem, but the price is extremely good value. And so we can use basically efficient market hypothesis to analyze the market is actually good value. The other economic principle we can use is be a contrarian. Now, contrarian investing is hard for people. I get it. It's hard to go and swim the opposite way. Have you ever been to a carnival and you've got multiple food vans and for some reason everyone's lined up for one van's food and, people then join that line. Human beings feel safe basically going the same direction, and you can be a contrarian at the food van stalls and go to the guy that's not selling anything, and you'll get served faster, probably be the same quality of food, and you'll probably give you some other things to do, right? We've all seen that. I think the phrase is monkey see, monkey do. So contrarian investing is the strategy where investors effectively go against the prevailing trend. Contrarians ultimately believe that markets often overreact to news and events, leading to mispricing. And when markets overreact to news and events, it dents confidence. And that leads to a mispricing. Now, I would say definitely the land tax thing, just having paid some land tax for a property I own in Melbourne, I mean, it's annoying, but $900 ain't going to change my world whatsoever. And so is that leading to a mispricing? Yes, it is. With $900 multiplied by 10 over 10 years, let's call for one of my investments in Melbourne, it's a $10,000 land tax over 10 years, $1,000 a year, let's call it. Is that going to change the world for me? Is it going to change the economic algorithm in my retirement? Well, not really. I mean, by 0.0%. But does it create an opportunity for someone to buy a mispriced asset in Melbourne? The contrarian investing algorithm tells me it does. And so if we look at the confidence, it's been bashed, creating the opportunity. The final economic theory is animal spirit by economist Keynesian. Or Keynesian economics, John Keynes basically, that he described animal spirit as an instinct, emotions driving economic decisions. When confidence is high, people are willing to take more risk. And so when confidence is low and uncertainty is high, then he believes people avoid taking the opportunity. So it's kind of like a upside down paradigm. When risk is higher, people are happier to take the risk. When risk is lower, people aren't as confident to take on the opportunity. And so if you looked at a high price marketplace today, and where a marketplace which has had incredible amounts of growth, people still want to buy there. If you look at a marketplace which has had zero growth, people don't want to buy there. That's the interesting paradigm of how economics works and how confidence works. So in conclusion, if you were to, for example, analyze the Melbourne market, you would have to say it's a very contrarian investor market. it's very good for investors that are seeking a long length of the next property cycle. If you were to analyze Keynesian economics, the animal spirit, really it's very, very useful to understand the market timing of the economic confidence. And of course, the fact that it's an efficient market right now under efficient market hypothesis, EMH, you can really understand that it's a bit of a reality check, EMH. Is the Melbourne market in reality underpriced, and is the offering of Melbourne in reality a very good offer? You get 200 years worth of history, you get 5 million people, you get bucket loads of trams and trains and transport nodes. And is Melbourne actually, under efficient market hypothesis, a very safe market that is simply underpriced? And when you look at that conclusion, you can work out basically where a market downturn can find you value in real estate. And really, folks, that is how to decode a market downturn for future gains. E equals MC squared. All right, I got that out. I hope that lesson was worthwhile. Thanks, folks. Thanks for tuning in, and don't be shy to leave me a review. We need more listeners. Reviews equal listeners, and I need more of them. So if you're a fan of the show, do a brother a favor and leave a review. All right, folks, take care. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. And I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.